Welcome back to Investing Talk podcast.
Today we're looking at Netflix.
As usual, before we start, subscribe, like, and comment to this video to support the show because we really have a fascinating situation to unpack today.
We really do. Well, it's one of those rare moments where conventional market wisdom just gets completely flipped on its head.
Right. I mean, our mission today is to break down this colossal corporate windfall and, really understand exactly how avoiding a mega merger is driving one of the strongest surges we've seen in the entertainment sector.
It's a phenomenal story, honestly. The defining news surrounding them right now, the event that's shaping their entire market position, is their decision to just walk away from that highly publicized bid for Warner Bros.
Which is crazy on its own.
It is. And the kicker, by walking away, they netted a staggering $2.8 billion breakup fee.
Billion with a B.
Billion with a B. Just for stepping away from the negotiation table.
I have to put my skeptic's hat on for a second here because this is so unusual. Usually Wall Street loves a flashy acquisition, right?
Oh, absolutely.
The traditional playbook for a CEO is to buy growth by swallowing up competitors. So it is exceedingly rare for the market to actively reward a company for not making an acquisition. But that really sets up the central theme of what we're analyzing today, which is capital discipline.
Exactly. And just to give you an idea of how rare this is, usually, breakup fees hover around maybe 3 to 4% of a deal's total value.
Right. Just a slap on the wrist.
Yeah, they're just designed to cover legal costs and, a bit of opportunity costs if a merger falls apart. But for a company to walk away with almost $3 billion, that means their legal team constructed an absolute ironclad safety net.
A masterclass in contracting.
Truly. They structured the negotiations so that if the regulatory environment looked too messy or the financials just didn't align perfectly, they could pull the ripcord and get paid handsomely for their time.
It really makes you wonder about the negotiations in that boardroom. I mean, I have to ask you, the listener, directly. Have you ever seen a company get paid almost $3 billion just to walk away from a deal?
It's unheard of.
It's a monumental strategic win.
Just think about the mechanics of a windfall of that magnitude. That is $2.8 billion of pure liquidity dropping straight onto the balance sheet. They didn't have to sell a single premium subscription, produce a single hit show.
Run a single ad.
Exactly, or run a single ad to get it. When you look at the broader media landscape right now, their legacy competitors are just bogged down in crippling debt, trying to consolidate. By taking the cash and maintaining their strategic clarity, they effectively outmaneuvered the entire sector without firing a shot.
Let's pivot into the fundamentals to see what's under the hood, because that $2.8 billion check only goes so far if the actual business is struggling, right?
Yeah.
Let's look at the revenue and earnings trajectory to see if they're actually making money organically.
Well, the top-line growth is stellar. If we look at the fourth quarter of 2025, revenue cleared the $12 billion mark.
Wow.
Yeah, to put that into perspective, that's nearly an 18% growth rate compared to the previous year. And what's really crucial here isn't just the sheer size, it's the momentum.
Acceleration.
Precisely. Growth was hovering around 15% in the second quarter, climbed to 17% in the third quarter, and then accelerated again in Q4. Zooming out to the trailing 12 months, they've brought in a staggering $45.2 billion in revenue.
Those numbers are astronomical, but, as the old market adage goes, revenue is vanity, profit is sanity. So how much of that $45 billion are they actually keeping?
That is where the story gets even better. Operating margins expanded significantly in 2025, pushing toward the 30% mark.
30%, that's massive.
It's a very healthy jump from the roughly 26% we saw in 2024. And looking ahead, management is already guiding for an even stronger first quarter of 2026, targeting $12.2 billion in revenue.
I want to pause on that 30% margin because I think it highlights something crucial for the listener. Operating leverage is essentially the holy grail for a tech platform. It means your fixed costs, things like your app infrastructure and your core corporate expenses, stay mostly flat while your sales go up. They already built the platform. So when they add 1 million new subscribers, almost all of that new subscription money goes straight into their pocket as pure profit.
That's exactly how operating leverage works. It's a testament to them moving past the old growth at all costs phase of the streaming wars.
Yeah.
We all remember the era where platforms were just throwing blank checks at any producer with a script.
Oh yeah, the Wild West.
Right, but now they've entered a phase of highly profitable maturity. They're utilizing extremely strict discipline regarding content spending.
Which brings us perfectly to their financial health and cash position. Examining the balance sheet, it reads like a fortress. We're looking at 55.5 billion in total assets against 26.6 billion in shareholder equity.
Yeah.
But the metric that really stands out to me is the debt management. Right now, they're sitting on over $9 billion in cash and short-term investments, and their long-term debt is roughly $13.5 billion.
In the media sector, where legacy companies are routinely carrying tens of billions of dollars in debt from old cable network acquisitions, that ratio is remarkably conservative.
Right.
It's the ultimate safety net,
Mhm.
and it allows them to generate immense free cash flow. In 2025 alone, they generated $9.5 billion in free cash flow.
Let's define that for a second, because free cash flow is the lifeblood of any business. That's the money left over after you keep the lights on, pay your employees, and fund all that expensive new content. Producing almost $10 billion in cold, hard cash in a single year gives management an arsenal of options.
It absolutely does. And what's fascinating is how they're deploying this arsenal. They're aggressively funding a $20 million annual content plan.
20 billion.
Yeah, that guarantees a constant stream of new shows and movies, which keeps the subscribers hooked. But simultaneously, they're returning substantial value directly to shareholders through over $9 billion in stock repurchases.
It's a dual-engine approach. You fund the product to keep the consumer happy, and you buy back your own stock because you believe the market is undervaluing your company. But let's talk about why that product is so sticky. A $20 billion content spend is phenomenal, but how does that translate to consumer behavior? We have to examine their competitive moat.
The moat is built almost entirely on network effects and cultural relevance. They currently have 325 million global paid memberships. When you have an audience that size, the switching costs actually become quite high.
I want to push back on that slightly. Are the switching costs really that high? It takes about 3 clicks on a smartphone to cancel a $15 monthly subscription.
Financially, yes, it's easy to cancel.
Yeah.
Culturally, it's very difficult.
Oh, okay.
Think about how hard it is to cancel a service when everyone at the office or in your group chat is talking about the new season of their flagship show. It isn't just about saving $15 a month, it's about FOMO.
The fear of missing out.
Exactly. You're losing access to an exclusive intellectual property library that dominates the cultural zeitgeist. Plus, their recommendation algorithm have years of viewing data on these users, creating a highly personalized experience that a brand new streaming service simply cannot replicate overnight.
That's a phenomenal point. The switching cost isn't just financial, it's cultural. However, I want to focus on what I see as the ultimate growth engine moving forward, the ad tier.
Oh, definitely.
For years, analysts worried there was a hard ceiling on this business. They thought, eventually you can't raise subscription prices anymore without causing a revolt. But the ad tier completely changes the math, doesn't it?
It rewrites the entire equation. The ad-supported tier grew over 150% to more than $1.5 billion in 2025. This proves they can diversify their revenue streams and continue to grow their top line without relying purely on squeezing the consumer for a few more dollars every month.
And it serves as the perfect release valve for pricing pressure. If a user feels the premium tier is getting too expensive, they don't cancel and leave the ecosystem entirely. They just downgrade to the cheaper ad tier. And the irony is, through advertising, that user might end up generating just as much, if not more, average revenue per user over time.
We'll go over the charts and the technicals.
Yeah, let's look at the price action,
Okay.
because what we saw on February 27th, 2026 was explosive. The shares surged 13.52% in a single trading session, closing right around $96.24. When a mega cap stock moves over 13% in one day, it is an absolute earthquake in the financial market.
It really is. And the significance of this breakout cannot be overstated. The stock broke out above the recent $96 resistance level.
Let's translate that for anyone who doesn't stare at stock charts all day. A resistance level is essentially a psychological ceiling. It's a price point where, historically, sellers step in and push the stock back down. Breaking through that ceiling, especially with a 13% gap, means the market psychology has fundamentally shifted.
Precisely. And what makes this specific breakout so compelling is that the momentum is heavily backed by volume.
Which means it's not just retail traders clicking buttons on their phones during their lunch break. High volume means the big institutional players, the pension funds and the hedge funds are piling in. They're buying millions of shares at a time.
The heavy volume signals that large investors are eagerly rewarding the company's strategic clarity. And we need to remember the macroeconomic context here. This surge happened amid broader market declines.
Right.
While the rest of the market was struggling and flashing red, investors sought refuge in a company that just secured a multi-billion-dollar windfall and successfully avoided a messy, debt-fueled acquisition. They became a safe haven asset on a day when tech was bleeding.
Let's gauge the market temperature and shift to sentiment, because the narrative surrounding this company right now is remarkably uniform.
The financial press is overwhelmingly bullish. It's actually quite difficult to find a major financial outlet publishing a negative thesis right now.
Almost impossible.
Yeah, the headlines are universally calling them a winner, specifically because they avoided the debt pitfalls that their legacy competitors are currently facing. Paramount, for instance, is out there trying to convince regulators to approve deals while managing colossal debt loads. Meanwhile, Netflix just collected a breakup fee and walked away with a clean balance sheet.
And the Wall Street analysts are updating their financial models aggressively to reflect this reality. We're seeing price targets sitting at $120. Now, from that $96 breakout level, a $120 target implies a substantial 55% upside.
Which is huge.
Yeah, if you stretch that out over their projected timeline, it represents roughly a 16% annualized return. But let's look at the assumptions baked into those analyst models. To justify 120, they're assuming an 11.7% compound annual growth rate for revenue, and they're expecting those operating margins we discussed to hit nearly 35% through 2028.
Those are ambitious targets, undoubtedly. Pushing margins to 35% requires flawless execution. But they're entirely grounded in the fundamental cash flow generation we just discussed. Furthermore, it isn't just the outside analysts who are optimistic. Look at the insider flow and the corporate actions. That $9 billion in share buybacks, that acts as a profound signal of insider and institutional confidence. Management is essentially looking at the market, looking at their cash flow, and saying, the highest returning investment we can make right now is in our own equity.
It's the ultimate put your money where your mouth is move. But beyond the hard numbers, there are some speculative catalysts floating around that we need to touch on. There are unconfirmed but highly persistent rumors that their CEO was recently visiting the White House regarding Warner-related strategic transactions.
And we should be explicitly clear here for the listener. We are looking at this strictly through an impartial business and regulatory lens. We are not endorsing any political viewpoints or taking sides regarding the current administration's stance on corporate monopolies. We're simply reporting that the market is watching these potential high-level regulatory conversations very closely. The Department of Justice and the FTC have been highly active lately, and understanding the regulatory chessboard is vital for investors.
Exactly. It's about navigating the legal landscape, nothing more. And speaking of rumors, there is also persistent chatter about a substantial expansion into live sports.
Oh, that's the big one.
Right. If they start bidding on major global sports rights with that $9.5 billion in free cash flow, the advertising revenue potential becomes staggering. Sports are the last frontier of appointment viewing, which is an absolute goldmine for advertisers.
Which perfectly sets up the catalyst calendar for the next 3 months. Investors are looking for concrete updates on these speculative fronts. First up, we have the first quarter 2026 earnings coming in late April. The market will be laser-focused on whether they hit that $12.2 billion revenue consensus.
And they'll also be scrutinizing the upcoming content slate reveals. When you are spending $20 billion a year on content, the market wants to see exactly what that pipeline looks like. Will there be live sports announcements? Will there be new sprawling exclusive franchises? The next few months are going to provide a lot of clarity.
Absolutely.
But as always, we can't just look at the rosy projections. We need to look at the flip side. Let's execute a deep analysis into the bear case.
A critical assessment of the risks is essential, especially when market sentiment is this universally optimistic.
Yeah, I'm looking at the primary threat here, which is intensifying competition and aggressive bundling from tech giants, specifically Apple and YouTube. What worries me is that these are companies with effectively infinite balance sheets.
Right, they play by different rules.
Apple doesn't need its streaming platform to be its primary profit engine. They make their money selling iPhones. They can bundle their services with hardware, essentially operating at a loss indefinitely to capture market share. Does this eventually cap Netflix's pricing power? Could it cause a spike in churn if consumers decide an Apple bundle is simply good enough?
It is a profoundly real threat. If the consumer's wallet is stretched thin by inflation or economic headwinds, a bundled offering from a $2 trillion tech giant looks highly appealing. You cannot underestimate a competitor who does not need to turn a profit on the specific product they are competing against you with.
Right. And looking at the stock's 52-week range, it's been wildly volatile, swinging from $75 all the way up to $134. That extreme volatility tells me that the market is constantly pricing this competitive risk in and out of the stock. Investors are clearly nervous about these deep-pocketed tech rivals.
Then we have the secondary threat, which is regulatory scrutiny. We touched on this with the White House rumor. There is sweeping media consolidation happening right now across the industry. Look at the intense scrutiny the potential Paramount Warner Bros. Deal is facing in Washington. As the dominant player in the streaming space, there is a risk of sector-wide regulatory spillover.
Meaning they just get caught in the net.
Exactly. Regulators might decide to implement broad rules that affect the entire streaming and media landscape, catching everyone in the crossfire regardless of their specific actions.
That's a fair point, though I would argue, based on the data, that they maintain a much cleaner regulatory profile than almost any of their peers right now. They walked away as a part bidder from the Warner deal. They aren't trying to merge two legacy media empires with conflicting television channels and studio assets. They're pursuing purely organic growth in their current trajectory, which shields them from the worst of the antitrust headaches.
I agree with that assessment. When you weigh the risks of Apple's bundling or potential regulatory spillover against the raw financial power we've discussed, these risks seem largely manageable. And the reason they are manageable is precisely because of the explosive growth of the ad tier and the incredible $9.5 billion in free cash flow. When you have that level of cash generation, you have the agility to pivot. You can lower prices if needed, or you can outspend any competitor on crucial intellectual property. Bringing all the data together, it's time for the verdict.
Let's do it. Lay out the final quantitative rating based on everything we've unpacked today.
Based on the synthesis of the fundamentals, the aggressive technical momentum, the overwhelmingly positive market sentiment, and the manageable risk profile, the final quantitative rating is a bullish score of 9 out of 10.
A 9 out of 10 is as strong a conviction as you will see in this market. So let me deliver the final multi-year investment thesis, the elevator pitch, if you will. Their disciplined exit from the Warner bid didn't just save them from an integration nightmare. It gave them a $2.8 billion cash windfall. They are taking that cash and fueling an untouchable $20 billion content moat while executing heavy share buybacks. When you combine that capital discipline with revenue growth pushing 18% and operating margins hitting 30%, they are thoroughly and fundamentally outshining every legacy media peer in the space.
And we really need to emphasize the target horizon here. This isn't a quick swing trade based on the breakup fee news cycle.
Right.
This is fundamentally a multi-year hold into a 2028 valuation unlock.
Right.
The math is driven heavily by the ad tier, which is expected to double, reaching $3 billion in revenue by 2026. That ad revenue growth is the core catalyst that supports the $120 plus price point over the next couple of years.
It really is a masterclass in strategic positioning. Which leads me to a final provocative thought for you, the listener, to mull over. We've talked extensively about how rapidly the ad tier is growing and how much pure cash it's generating. If this advertising engine becomes efficient enough and profitable enough, could we eventually see a world where they introduce a completely free, entirely ad-supported tier?
Oh, wow. That would be something.
Imagine the disruption if they decided to establish total global dominance by capturing the billions of viewers worldwide who still can't afford a monthly subscription. If the ads pay for the content entirely, why charge a subscription at all? It's a fascinating possibility to explore on your own.
It really is.
With that, we'll wrap up this analysis. As always, subscribe, like, and comment to this video to support the show. We will see you next time.